begins to slow down. Lots of economic data now starting to disappoint expectations. We're starting to see manufacturing slow down. The NFIB, which is the National Federation of Independent Business, they reported their survey yesterday. Now, the National Federation of Independent Businesses basically is a representation group for small to mid-sized businesses. So the Apples, the Microsofts, they don't belong to NFIB. This is mostly small to mid-sized businesses around the country. And, they take a survey once a month talking about, well, what are you seeing in terms of inflation or pricing or sales, your economic outlook. The economic outlook for small to mid-sized businesses is about as bad now as it was at the bottom in 2008. So the outlook economically is not good. We're starting to see plenty of evidence now. The consumer starting to be impacted by higher prices. And of course, as we've said before, the cure for high prices is high prices because that creates demand destruction. It's one of those big funky terms out there that basically just says that consumers can't afford to buy more stuff. That's all that means. And again, as they run out of money, their demand has to slow. And as that slows down economic growth because our economy is 70% consumption. It's just math, folks. I mean, it really just doesn't get any simpler than this. But that all leads, of course, as inventories are now building up, that leads to lower prices. As demand slows, higher prices have to come down in order to find people to sell stuff to. That's just economics. It's just the way it works. Supply and demand, and this has just been a function of the problem. And this is the issue with government, is that their solution to solving high prices is to do stuff that creates high prices. So, doing things like sending checks to households, right? Give people more money to spend. And I understand, look, we want to help people. I get it, right? It's always a function of wanting to help people. It's a feel-good thing, right? Let's help everybody. I'm all in. Let's figure out a way to help everybody, right? But there's a consequence for helping everybody. And sometimes you just need to let the economy operate as it needs to operate, and we solve these issues. Now, yes, is it painful in the short term? Of course. But this is the consequence of having, after almost a decade and a half now, of trying to avoid recessions, we keep creating bigger and bigger problems. And again, this is just something that are lessons that have yet to be learned by our elected officials in Washington, is that we can't solve the problems, and you can't just inject money into the markets and hope that will just alleviate a short-term pressure. You don't shut down economies because of a virus. You just don't do these things. And the carnage of doing things like shutting down an economy or sending checks to households was evident early on. We were writing about the sugar rush a year and a half ago, saying, look, if you do this, if you send all this money to households, you're going to create a sugar rush. And if you've got kids, you know what happens when you put kids on a bunch of sugar. They run around like crazy for 30 minutes and you find them balled up in a corner somewhere snapping. It's just, they're out like a light. And that's just because when that sugar runs through the system, the system shuts down. And that was evident of what was going to happen in the economy. And so here we are, and now we're having the payback. As we said yesterday, free money isn't free, and you're going to pay it back in one form or another, and this is how you pay it back, through inflation. But this is also the problem, as we talked about before, with modern monetary theory, which is neither modern monetary or a theory. This idea that government can just send money to people and it's all fine and dandy. It doesn't work. It doesn't create incentive to work. It doesn't create better economic outcomes. It doesn't work. It's called socialism. And socialism has never worked in any economy ever in history. So, again, we don't learn from history. And maybe part of that problem is the fact we don't teach history in school anymore. But we don't teach history. It was interesting. My daughter came to me over the weekend. And she goes, Dad, I've got this big project to do at school. And I was like, well, what's the project about? She goes, I have to write an article on a dystopian and a utopian society. And primarily, how does a utopian society fall into dystopia, right? And I'm like, well, and my brain's already running and saying, well, honey, you just need to go read the book 1984 by George Orwell. But she didn't have time to read a book over the weekend, right? She had to write the report. Of course, she procrastinated to the last minute, and here it is, end of school. So we watched Elysium with Matt Damon. Yes, but same idea, right? I mean, this is how you wind up with this split society. The rich basically are leading the great life, and everybody else is not. And these are the challenges that we face as an economy today. We have this big wealth gap between the rich and the poor, and we're doing things that do not elevate and support the poor and middle class. We're actually doing things that transfer wealth from the lower and middle classes to the upper class. Now, if you're in the upper class, you certainly say, well, what's wrong with that? But, this is not what creates a more vibrant economy. But this is stuff we've been doing now for well over a decade and have not learned the consequences of those actions. Fed bailouts, quantitative easing. These are not supports for an economy. They are a wealth transfer tax from the middle and lower classes to the upper class, those that have assets. And that's why 90% of the stock market today is owned by the top 10% of income earners. So when the markets go up, well, their wealth has gone down here a bit lately, but that's why when markets are rising, the wealthy get wealthier, and not the middle class, not the lower class, because they're not invested in the markets. They have very little exposure to asset prices. So long way around the block here this morning to talk about what we're going to get into this morning, which is this inflation is a problem, but we may have seen the peak of it. And that's going to start to lead to more disinflationary pressures as the economy begins to slow towards a recession. Now, that doesn't mean that we're going to have this massive 50% decline in the markets. Don't think that, because the average drawdown just during a recession is about 15 to 20%, about where we are right now. The difference between that 15 to 20% drawdown during a normal recession and a 50% drawdown like in 2008 is that you need a contingent exogenous event, which is generally credit related, like the subprime crisis, on top of the recession. So the question is, will the Fed hike rates at this point to the level that creates some type of credit related exogenous events in the markets? We'll explore that a little bit this morning. Buying the dip, where are we now, what the outlook is. That's all coming up right here on the Real Investment Show with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Well, Brand, if you were paying attention, you wouldn't be running over curbs this morning in our Length Challenge bus.
The ramp was dark.
Gotcha. Lights were out on the bus, is
Yes.
what you said?
Yes.
Gotcha.
Driving by Braille.
Good morning. Welcome back to the show. My favorite guest is joining me this morning, Hugh Hefner, live from the Playboy Mansion. Wow, that is some kind of jacket you have on this morning, Mr. Ratliff.
Thank you.
When you woke up this morning, you said, I think I'll wear my smoking jacket to work this morning.
Did that thing
about
come
the
with?
mood.
Did that thing come with batteries?
Of course. Of course.
We're just joking. If you're not watching our live stream on YouTube, you kind of miss all the visuals. But Danny has a very bright watermelon colored jacket on this morning
With accents of blue.
Exactly to match his shirt.
Yes.
So he at least did match.
Hey,
right?
at least I wear
True.
something besides bowling shirts, okay?
Yeah, it's true. But when he gets up in the morning, Michelle did a good job for
Yes.
him. She put garanimals on the back of all of his clothes. So all he has to do is match them up so he gets the right colors for the right
Hey,
pants.
man, you got to make life easy, Life's hard enough as it is.
Garanimals
That's
for
why I just
adults.
wake up every morning and wear a golf shirt. It's really easy. I'm like Albert Einstein. I don't waste any mental energy on getting dressed.
Oh, man.
Good morning. How are you? I'm
Doing well.
just joking with you.
Oh, all good. All good.
All right, so a couple of things. I was just kind of wrapping up the last segment talking about buying the dip here. And, of course, this morning we've got inflation coming out, likely to be a little bit weaker than expected. And we'll see how it comes out. I mean, it might be right in line. We're right at the tail end of this kind of inflationary spike that we had in the market from monetary inputs. Now, the M2 money supply is dropping off here rather quickly on a year-over-year rate of change. So that's going to start to feed. There's a very close correlation, obviously, to monetary supply and inflation. Runs about a 9-month lag. So we're now right to that point to where inflation is about to start reflecting the drop-off in the rate of change of monetary supply. Now, I know that's a lot of big numbers for you this morning, and it's early, and I'm not asking you to do math. Just trust me on this. But if we're right here kind of at that juncture, so if we don't get a little bit weaker, inflation number today, it'll be in the next month or two. And the reason is because the year-over-year comparison rates are coming up very quickly. The inflation number this time last year was where it was really starting to take off and everybody really started kind of focusing on inflation. And we've been talking about inflation now for a year. So not surprisingly, we're just kind of at that point to where we're going to see that peak and that reversion. Now, again, as I've stated before, just to be clear, that doesn't mean the gas at the gas station gets any cheaper, right? It just means it stops going up as much. Okay, so that's all it means. Now, at some point, prices will fall as we get further into a recession, and that's the differential between disinflation, which is where the inflation rate is just kind of moderating or declining, to going negative as we get into deflation. In other words, the rate of change becomes negative in inflation. That'll happen during the recession, and that'll be later on this year or early next year, unless the Fed is somehow magically, for the first time ever in the history of the Federal Reserve, is able to actually engineer a soft landing that doesn't put us into a recession. But I wouldn't take odds on that. That's probably not a good bet.
But it seems like individual investors are betting that that's going to be the case, because if we look back at numbers here back in March, we saw $28 billion of U.S. listed stocks. ETFs were actually purchased. We saw in April another $24 billion. And in fact, just last week when we had that 3.6% drop in the S&P, people swept in. We didn't see it necessarily in the index pricing per se, but studies show that $2.6 billion were actually purchased that day.
Yeah, and again, the problem is knowing where that money's coming from.
Yeah.
A lot of it's stock buybacks. The stock buyback window is open back up, so that's obviously providing some support here. And again, if we kind of start to see markets move up, we'll start to see those buybacks even pick up more. But the other side of that also too is that investors have been trained to buy the dip. And that's, everybody's trying to hope. And this is, we were talking about on Monday, was it, Brent? We were talking about Rich Strike.
Yes.
So did you see the Derby over the weekend?
No.
Or hear the story?
I know the story, yes.
Okay, so Rich Strike came.
Come on, I came from the Derby with
yeah,
my
exactly.
jacket. What are you talking about?
This is the point. But yeah,
still there. Come on.
So if you don't know the story, Rich Strike came. He was literally in the back of the pack of horses, and Epicenter is at the front of the pack, and they're in the home stretch. Epicenter slated to win the Kentucky Derby, and Rich Strike comes from all the way in the back and wins the race. Right at the dead last second of the race, and just a phenomenal upset here. But that's what investors are betting on. We've trained investors over the last 2 years in particular to buy dips, and everybody keeps hoping that this dip is going to be the dip to buy, and then we're going to get this massive rally in the markets and things are going to take off again. We're going to have a repeat of the March 2020 lows. And look, we're victim of that too. I mean, we're looking at all our statistical data going, man, markets are extremely oversold here. We wrote an article yesterday on the website talking about investor sentiment, which is so extremely bearish. You would think that we're actually, at a point in the markets of 2008 during the financial crisis. That's how bearish investors are sentiment-wise. But to Danny's point, they're super bearish on the sentiment, right? The market's about to crash, but I don't really want to sell anything, right? Just in case. And that's it's really kind
people don't want to pay taxes.
And they don't want to pay taxes, but more importantly, they don't want to miss out. Despite the negative sentiment, they're still afraid of missing out on the rally, because that's what we've trained investors to do now repeatedly. And everybody's kind of expecting any moment now the Fed's going to reverse course and come in and go back to QE and run stocks back up. We'll see what happens. But it is interesting, Danny, to your point that, despite the negativity that we see and hear and feel and everything else in the markets, investors are still trying to buy that dip.
Well, they are, and it's interesting. I was reading an article about a gentleman who retired, and he actually has a lot more in stocks right now than he did when he actually retired. He had about half his portfolio. Now he's looking at more than about 66 to 70 some odd % in equities, and he continues to increase exposure, yet he continues to lose money. Mm-hmm. And so that's the difficult aspect of where we are right now. This thing we could see this bounce. I mean, we've talked about a reflexive bounce here for a bit. Markets being extremely oversold. But this guy's making a fundamental decision that this is going to be long-term. We're going to be much better off. And I do believe that. I really do that, next couple of years, we're likely going to be in a way better position. But what does it take to get there?
Yeah. And again, part of this is also that we've got to reverse that sentiment. In a lot of cases, where real bear markets bottom is when investors no longer want to own equities, period. It's when you talk to somebody and it's like, hey, we need to be buying stocks, they're like, no way. There's no way I'm investing in the markets. That's just crazy talk. That's when you want to be buying the bottom. And we're not there yet. There's still, too much interest in the markets at this point. And you've got to really, those true buying opportunities come like we saw back in 2009. Nobody wanted to own equities at the bottom of the financial crisis. It was like, this is crazy. This is just, done. And they didn't come back for years, right? And, still, and this was the problem with March 2020 and why March 2020 wasn't a bear market, is because investors were too willing to jump back in and take on excess speculative risk, at the bottom of March of 2020. And that's not what you see in a bear market. And at the bottom of a bear market, investors don't jump into the most speculative stocks. That's what happens during a big bull market correction. And that's what we saw there too, as well. So, but the real point here, Danny, and I guess this is the question is, of course, we're probably going to see this market rally and bounce a bit. And we're going to start to see a lot of people trying to come back into the markets thinking that the bear market is over. We'll probably see that. That's going to be the trap, though, of course, that's going to lure a lot of investors in because we still have a lot of headwinds ahead of us. Fed hiking interest rates, extracting monetary supply, economy slowing down, earnings are going to decline, valuations are falling. So there's still a good bit of headwinds for these markets over the course of the next few months.
Well, I think interesting. Earnings have been decent. I mean, if you look at them year over year, aren't they up like 11%?
They are.
But I think we're going to, like you mentioned, we're going to start to see some of these higher costs are going to really impact the overall health of these corporations. That's they impact consumers. I mean, we saw credit card debt go through the roof here over the last couple of months. I mean, I'm talking like, over billions of dollars. I think the average pre-pandemic was $15 billion. and we're like 50 something in March.
Yeah. Well, and again, the total credit card debt is right back to where it was at the peak of the credit card cycle just prior to March of 2020. So a lot of those people paid off credit card debt. Now they've put it all back on. So all that free money they got has now gone back onto credit because they can't, make ends meet. And that's not surprising. So, is there more room for people to leverage up credit cards? Absolutely. We'll see how much more there is, but that's going to be one of the impacts on what's happening, of course, with consumer spending and economic growth. And, Danny, you're right. Trailing earnings look pretty good. And again, not surprising. That was still kind of the tail end of, expanded unemployment benefits. Child tax credits ran out in December of last year. So there was still a lot of that monetary slosh still sitting in the system. But corporate outlooks this earnings season have really deteriorated. What they're saying about over the course of the next 6, 8, 12 months on expectations for earnings growth, for sales, those type of things have really become much more negative. And I think that's them starting to talk down earnings. And the interesting thing is that earnings estimates from Wall Street have really not come down that much. In fact, they've been ratcheting them up in the first quarter of this year. So there's still a lot of adjustment that needs to come down on these earnings estimates for these companies, which are already starting to warn this. They're saying, hey, things may be weaker over the rest of this year, and our earnings may be weaker because of that, but yet Wall Street hasn't revised down those earnings yet, which is helping support valuations. Even though valuations are coming down on a forward basis because of falling prices, once those forward estimates come down, valuations are going to fall even more. So just be careful with the forward estimate thing, because there's a lot of charts right now. It's like, oh, valuations are cheap because forward estimates have come down to 17 times earnings. Hang on. They still got to adjust. They've adjusted the P, but not the E yet. And that's still coming. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife took my youngest daughter down to the pool store to buy a float. My daughter finds this one that's as giant as you can imagine. This float of a dragon. So it's got this big head on it, and it's got a tail coming out the back end. Of course, it's the biggest float they have.
The Real Investment Show podcast.
Yesterday morning, my Ring doorbell goes off. Here's my wife chasing the dragon down the street.
At realinvestmentadvice.com.
Dragons are real.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Danny Ratliff joining me as well, of course, certified financial planner. You have an event coming up.
We do. We have the Truth About Life Insurance. It's going to be actually this Thursday, tomorrow at noon. So go to realinvestmentadvice.com. We're going to talk about all the things that Dave Ramsey doesn't want to tell you about life insurance. And so we're going to really cover the basics, 30,000-foot view, how we look at term, how we view permanent life insurance, where it falls for each person, and how you should best use these. Because I think that a lot of these get a bad rap. Also, many of them are sold, and we really think that they need to be planned for. So we're going to talk to you about all the tips that you need to know, things that you should take into consideration when you're actually doing this, and how you would use each different type of policy.
Best investment ever, whole life insurance policy.
Well, I think permanent life insurance can have it's a fantastic tool for many people. We get a lot of conversations with people who say, look, I make too much money. I can't put money into a Roth. I can't, where do I put other funds aside, maybe more tax efficiently? And that can certainly be one way to do so. And, so that's the things that I think that are so often overlooked, or they're sold that way, but then they're not actually used properly once you get into the product.
Yeah, I think that's the biggest thing that comes up is that, for instance, Dave Ramsey makes great points. When you're trying to get out of debt, and you're putting all your money towards getting out of debt, buy a term life insurance policy. That way, if something happens to you, your family's taken care of. But the thing about term life insurance policy is that you're supposed to buy the term, and then you're supposed to invest the difference between what you paid for term and what you would pay for a permanent life insurance policy. And then when the term policy expires, then you have a whole bunch of cash saved up, and you can basically self-insure at that point, right? So you don't need the insurance anymore. You've got plenty of coverage. If you pass away, everybody's taken care of. This is the whole point. The problem is that, as always is the case, we buy term, and then we spend everything else. So what happens at the end of the day is that you live to the end of your term. You've now spent 20 years or 30 years paying for term insurance, and it expires worthless. And you've just now wasted 30 years worth of money that you could have been investing in a permanent life insurance policy that was building a cash value, or investing in the stock market to become self-insured. But this is the problem, as is always the case. We are told simple solutions. Hey, just go do this or just go do that. But what happens, and again, this is what Danny and Richard are going to cover in this, and this is a big passion of mine, right? Because as somebody who I use permanent life insurance to fund other ventures because of a lot of, and they'll go into all the details as to why, wealthy people use permanent life insurance for more than just life insurance. There's a lot of benefits to it. Tax benefits, as well as tax deferral, tax-free growth, tax-free withdrawals, lots of stuff that you can do with a permanent life insurance policy that nobody tells you about, but can really help build your wealth over time. And for me personally, look, I build businesses, I invest in markets. My best investment ever, period, end of story, without a doubt, has been permanent life insurance. And if I could do it all over again, I would work at Taco Bell and just invest, and that way I could, have tacos every day, invest in permanent life insurance, and have the drag bunch show up to, tell me why I should eat more tacos at Taco Bell. Taco Bell drag bunch.
That's a thing now.
This is the thing.
So Lance, you make some really good points there. And life insurance, that's one of the things that, especially if you're younger, setting up some type of permanent policy can really be to your advantage, because you can use this and essentially, like Lance mentioned, you're gonna be able to use this and take a loan out. Now, there's a lot of different factors when we look at these policies, but the bigger thing, Lance, I think, is that many times we're told, even with a permanent policy, hey, you're gonna be able to put the funds here. We're gonna grow and accumulate cash value, and it's gonna be the greatest thing ever. The problem is that for these to truly act and run on all cylinders, you need to overfund it if that's the case you're going with. And so when we're looking for somebody who's looking for the accumulation aspect, we want to use term policies, kind of the hierarchy. Term policies are going to be this is what you're going to use for risk mitigation. You're going to really look at for how do you protect your family? God forbid something happens to you, your spouse. This is going to be the big kicker here. And for a set period of time, you have children. When will they be out of the house? Or you're continuing to accumulate wealth. When are you going to be self-insured? Now, you could probably always make an argument for some type of policy, depending on the stage of life that you're in. But these permanent policies can be great. The issue is they're never overfunded, so you don't actually get that growth. What we like to do with those types is we want to make sure that we can have a lower death benefit, because we're not in it for the death benefit. We're in it for the accumulation of wealth. And that's the bigger difference there, Lance. And then the other reason we would use a permanent policy would be for somebody who has quite a bit of wealth. They need to protect funds and assets from estate taxes. We know right now estate taxes, the number's way up there, the estate tax limit. But that's going to go down in 2026. In fact, yesterday the Treasury just talked about how they're looking, if they don't make a change already, which we heard last year with all the tax talk, they were going to reduce it significantly. Well, they're going to let this sunset in 2026 if they don't do something prior to that. And you're going to see a lot of people who did not fall into that spot where they're going to have a pretty big crunch on estate taxes. They will be in that situation. And this is another way to help mitigate that, help keep funds in your heirs' pockets, create that legacy, and then pay the taxes with the policy.
Exactly. Well, no, and that's look, with everything, of course, and you bring up great points. There's rules to everything, right? And you have to follow the rules. And that's my point about term life. Nothing wrong with term life insurance. 99% of people that buy term life insurance don't follow the rules. That's the whole point. So, no matter what and the problem is that, for people that just want to sell insurance, they badmouth everything else. And this is the problem with advisors. Look, I'm going to badmouth advisors right now. Advisors are the worst about selling insurance because they want to manage your assets. So they tell you, permanent life insurance, that's a terrible idea, because they want to manage your assets so they can charge you a fee on your assets, right?
Or you hear the complete opposite where they say, hey, we talked about it, a term policy versus a permanent policy. Yeah. For an agent, you're going to get more commissions with a permanent policy. Doesn't mean it's a bad thing, but you need to make sure you understand exactly what you own, what are the bells and whistles, what am I paying for? And, that's the other caveat. I know people who are, they work for very large insurance companies selling property and casualty, and, they start getting into, well, I've got to go get my Series 7. I've got to go get this. Well, why? Because we need to sell some VULs. Well, why do you need to sell VULs? Everybody needs one. Okay, really?
Why?
Let's talk about this. And that's the problem is that,
they're big commissions.
Well, but if all you have is a hammer, everything's a nail. And so you need to be a little bit more holistic in light of all these things. And, we talk about financial planning, and I'm beating that drum constantly, but that's where a really good financial plan, and really with all insurance, comes into play, because then we can back into these numbers and get a very good understanding as far as what exactly you need. And that's not just life insurance. It's long-term care. It's really any and everything that you're looking at doing there. That'll help create that roadmap and that blueprint for you.
Yeah. Well, and again, this kind of goes into our topic, which was, this was kind of a long beaten way around, getting to our topic about what advisors are telling clients to do in times like we have now, both the good and the bad. And, this is something that you deal with pretty much every day.
I do. Yeah. Yeah. And we talked about last segment how we're all these people buying the dip. I can tell you the majority of people we're talking to, they're not willing to buy that dip. Now, I think people are willing to say, look, we need to remain invested. We understand, we can't time this exactly. Things could shift quickly. And so I do think there is that, and people feel okay in that regard, especially if you're sitting on some cash as well, because one, you have you're insulated just a bit. And you also have that ability where, okay, if it is the time to buy the dip, we're going to be able to do that if we get a confirmation of a trend change. And I think that's the bigger part of it, knowing that you have that flexibility and some downside protection. But look, if things continue and we get a nice bounce, I mean, we've talked about different portfolio actions that we would take in light of all that's going on. And I think that's important. But, we're hearing the same narrative. Buy and hold, don't worry about it, continue to take the same exact distributions. And, for many who have continued to escalate their overall equity exposure, hey, I pray it works out. And look, we always hope markets go up. That's what we want. We don't like seeing money eroded. We want to see that, plans that work well. And I think the big thing here is that if you're going to continuously, add exposure here, you've got to be really cautious. And, for the buy and hold guys out there, you may need to start looking at, what do your distributions look like if things continue to deteriorate? Vanda Research actually just came out with some numbers that really kind of shocked me, Lance. They said the average portfolio is down about 28%. Mm-hmm. Now, if we look at the indexes, they're not down nearly as much. But the index, we've talked about how they're market cap weighted. That changes it a little bit because we've had a handful of companies that are really big that have not been down nearly as bad as the index, well, at least until about probably last week,
Exactly.
right? But now we're seeing that, when you looked under the hood, there were a lot of companies that were good companies that were really beat up. And a lot of people own those. So I think that's probably where we're seeing those much larger numbers, especially if you own anything in that growth sector.
Well, and two, the problem is for the average investor is that, A, they may own the same stocks as in the index, but they don't own the same weights.
Correct.
And, there's a lot of people that have owned Apple, Microsoft, Netflix, Amazon, and those have become very big positions in their portfolio, and other stuff in their portfolio has not. And so their market cap weighted, biases are out of tolerance. And this is one thing we talk about a lot on the show is about rebalancing back to weight. When things run up a lot, rebalance it back to target weight. So if it's, if Amazon's supposed to be 4% of your portfolio and it gets to 5 on a big move higher, trim it back to 4. And that way, when you do have these big corrective events, A, you've already locked in a lot of your gains, and B, it doesn't destroy your portfolio because of the decline those stocks have. And that's what's happening to a lot of people. And to Danny's point, most investors took on a lot of risk over the last couple of years buying stocks that were the innovators, the ARC-type companies, and those have been decimated. They're down 60, 70% this year already. And so if your portfolio owns that, there's a lot more pain in the average portfolio than what you see in the index. And that's really what's driving a lot of this move in the markets. We'll come back after the break, talk about behavioral biases here a little bit, and a couple other topics to wrap up the show. Don't go away. We'll be right back on the Real Investment Show with Danny Ratliff this morning.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the truth about life insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisor's free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, Another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. So talk a little bit here about behavioral biases. This is, again, everything we've been talking about this morning is really a function of what we do as investors. And there was an interesting article out in Barron's talking about, in fact, I wrote an article about this yesterday about investor sentiment is so bearish, it's now bullish. And I know that sounds weird, but that's contrarian investing. Investors tend to do exactly the wrong things at the wrong times repeatedly because of emotional biases, right? We try to, avert loss, so we start selling at the wrong time. And then when things are really negative, all we read is really negative stuff, which makes us even more bearish and more, apt to emotionally sell something at markets. Because right now the markets are just going to crash and die, and that's the kind of every headline in the media. When markets are bullish, they're going to go up forever, so we start taking on a lot of excess risk. And so again, we buy high, we sell low repeatedly, and which is why investors typically don't do well over the long term, despite an advisor will trot out a chart and says, well, if you just invested in the markets over the last 100 years, you'd make 8% a year, or whatever the number is. Investors don't do that. They don't make that because they repeatedly buy high and sell low, which destroys their returns over time. But that's emotional. That's behavior, right? That's what we do as humans. And, Danny, this article I thought was interesting by Barron's just because, here we are, markets are down. Seeing a lot of negative sentiment, and Barron's kind of got into this whole article about behavioral biases and things that we're doing.
Yeah, I think one of the bigger things that we typically see is recency bias. And, we've talked about this, how the goalpost continues to move in the sense of information and how quickly we receive it. And, I mean, it is phenomenal. And so in the aspect that, we're so tied to the recency bias as far as what has happened recently, what's going to go on, that we kind of forget to look forward into the future and say, okay, well, things have been great. So give you a great example, Lance. January raised some cash, and most people were, oh my gosh, what are we doing with cash? Mm-hmm. Lots of phone calls. Why do we have so much cash in a portfolio when the market's done so well? Well, the idea was taking some chips off the table, also seeing that things were a little bit overdone, and that, okay, now I think if we knew all that had gone on, we'd have a whole lot more cash at the moment. But nobody technically, really knows that. So the key there was that everybody thought, oh man, we've had such a great market. Why get out now, or why take some profits? And now the opposite is true. Now we're hearing more of, hey, we're going to take some more. It's funny because it was way too much then. Now it's not nearly enough now, because we've had such a troubling time here in the markets over the last several months. And I think that this is something that we talked about last year, even 2020. 2020's downturn was like 23 days, and we got past it. That was a really painful 23 days.
Yeah, it's terrible.
It was not fun. But now we're actually in something that's been a little bit more prolonged. And
9 months.
What's that?
9 months.
9 months.
We've been doing this since 9 months ago. So, yeah, and that's the thing, right? If you were invested in the markets last May,
yeah,
you're right where you were last May.
Yeah.
But that's just what's been going on here, right? We've given up a year's worth of gains, but really, if you look at your portfolio, you're right where you were in May of last year. Mm-hmm. So it feels, and this is the point about behavior and feeling and all this. It feels terrible, right?
Oh yeah.
But that's because one of our behavioral biases is what we call anchoring, right? And what do we anchor to? We anchor to the high water mark. So everybody looks at their portfolio from January of this year and goes, "Well, I'm getting killed here." No, you're where you were last May.
Yeah.
Right. I mean, but this is the problem, is that we don't keep things in perspective, right? Markets go up, markets go down, markets go up, they go down. And I'm not making light of the fact of the decline that we've had this year, because it has been painful, but it's been one of these very protracted consolidations since May of last year. We've gone up, we've gone down, we've flopped around a whole lot like a fish out of water. I mean, it's not been fun, but again, because we anchor, and so does the media, right? Every day you turn on the media, market's down 16% for the year. Yeah, it's terrible, right? But we were up 26% last year. We were up 120% from the March 2020 lows. Perspective is important to keep these behavioral biases in check, to keep you from making investment mistakes.
Yeah, I think that's a great point. You know, it's so easy to anchor to that high water mark. It's so easy to think that, you know, markets are only going to go up. And look, any little bit hurts. No, there's never an amount that when you see any of it go down, that you're going to be, okay. You know, and I think that, you know, but we need to understand how markets do work. We're going to have, you know, we'll take 2 or 3 steps forward, we'll take a step back, 2 or 3 steps forward, a step back. And, you know, markets do go up. And here's the one thing that I want to caution everybody on is that the big thing that we hear in times like this is that the markets go up more than they go down. And while that is true, but a lot of that time they're just trying to get back from being down. Right. Before you go and make new highs. And so we need to take this into perspective as far as what that means for you and your money. And this is why we believe that active management and risk mitigation is so important, because you could write this thing down and you'd likely be okay if you don't need distributions, if you have a long time period, no big deal. But and for an accumulator, you could use this. This could be a great, you know, tailwind for you. In the sense that you're putting funds to work. You know, another big mistake people make, Lance, is that, well, I stopped my 401k, I stopped my contributions right now, or I just put everything into cash, didn't do anything. Well, you may be presented with a really nice opportunity at some point here in the future. Right. And so we want to make sure that we're always putting those funds aside, because I hear that advice too. Oh, yeah, stop everything, don't worry.
Yeah. Well, the problem is always, of course, is the getting back in part.
Yeah.
You know, look, one you know, again, look, I get it, right? Every advisor, every portfolio, et cetera, is always benchmarked against year-to-date returns. What happened between January and December 31st, right? That is irrelevant to your money. I benchmark my personal portfolio on a 2-year basis. Where was I 2 years ago? Where am I today? Why? The reason is because as long as I'm making gains, I'm heading towards my goal. And what happens within a given year is irrelevant long-term. So my anchor point is 2 years ago. And I go back 2 years. Where was I 2 years ago? Where am I today? That's my benchmark. Because again, my goal is to create an average rate of return over time. I'm not worried about really what happened over the last month or 2 or 3. Volatility is part of the game, and you've got to understand that when you're investing. So if you start setting realistic objectives and start saying, you know, where was I when I started versus where am I now, and where am I in relation to my goal? And this is one thing that Danny and Richard do very well with clients, is setting these long-term pathways, saying this is where we need to get to, and we just need to generate this much money a year to get to that goal. And if you can do that, you're going to be fine. But that's a much better way to benchmark. Benchmarking to your financial objective is much better than benchmarking to an index, because an index is going to require you to take on way too much risk in order to meet or beat that index. And that's the whole problem with passive indexing, which is you're striving to be average. And that's not really our goal of investing over time.
But is anybody ever really passive? No, because they're buying, they're selling.
Yeah.
We may use these passive instruments, but that doesn't mean that you're actually a passive investor. I haven't met one of those yet.
No, they don't exist, because you know, as soon as you make a decision, so you're buying a passive S&P and, you know, emerging markets and international and bonds, whatever. So you build a whole portfolio of passive instruments, but as soon as you make a decision to change anything, you're now an active investor. So, and to your point, Danny, there is no passive. Ultimately.
Well, and even that, I mean, you've made this point before. If a company gets taken out of the index, they just take it out. Whereas you're hurt. Yeah. It has a negative impact on you and your money. Whereas that index, it just changes. So, you know, those are all things I think that need to be taken into perspective, especially in times like this. It's really easy to get emotional. You know, and I think everybody just needs to take a step back and say, okay, what does this mean for me? Do I have a plan? Go update that plan. Understand where you are. And I love what you said, looking at it on a rolling basis, you know, every 2 years. And I think that, look, it is important to manage and understand, you know, where you are, you know, in a short-term basis. Understand how, if you need to raise additional cash, if you can't sleep at night. I don't think there's ever an amount of return that anybody can achieve that's worth their health or their sleep. And I think that's counterintuitive from a lot of what advisors will tell people, but there's really not. If it's going to be bothering you that much or impact your life, then you probably do need to just say, okay, hey, let's take a breather, but have a plan to actually manage the funds, understand where you're going to go with them, and have an entry strategy as well. That's the problem, right? Nobody, once they get in, they don't have that extra exit, and once you get out, nobody has an entry point either.
Yeah, and look, that's hard. Look, I absolutely agree with you. I tell people this all the time. It's like, oh man, market's really just killing me right now. Well, get out. And they're like, well, I can't. I might, I'll miss the rally when it comes. It's like, yeah, but that's okay. Can you sleep at night? Yeah. Is your money safe at that point if you're all in cash? And look, I'm not recommending you go to cash, but the point is if this is creating mental and marital distress, get out of the market, right? It's like like Frogger crossing the freeway, right? Stop running in front of traffic if it's stressing you out, right? As long as you're able to maintain it and lead a healthy life, that's the important thing, right? Your health and your marriage, those are the most important things. And if investing in the markets is stressing you out, quit. It doesn't mean you can't get back in later when things calm down. And again, the hard part is you're going to miss the rally. You're going to miss the recovery. And guess what? That's completely okay. Nothing wrong with that. Bear markets are generally fairly short, generally 12 to 18 months. Bull markets tend to last for several years. So even if you miss the bottom, who cares? When the market starts recovering, get back in the markets and start enjoying the returns from there when things calm down and you can handle the volatility. But if you can't handle the volatility, A, that tells you two things. One, you're not meant to really be an investor. And B, you've got the wrong allocation. So you can fix the allocation pretty quick, but you can't fix the investor part. That's just a function of your personality. And it's okay. There's nothing wrong with that. Not everybody's meant to be an investor. That's why there's certain people that do it and certain people that don't. Just, defer to what your abilities are and manage your money accordingly. And guess what? You're going to be fine in the long term. And saving is the best way to build wealth.
Well, it is. It's your human capital. And is it doing the right thing financially? We can make arguments, probably not. But be cautious. Understand yourself. I think that's going to be the biggest thing. If y'all have questions, go to realinvestmentadvice.com, ask a question. Lance gets to you right away.
I do, every day. All right, wrap up the show. 3 minutes of markets and money coming up. CPI coming out this morning. Markets pointing up this morning. We'll see what happens. We'll talk about it more tomorrow as well with Michael Leibowitz. We'll talk about CPI and how the Fed may respond tomorrow with Michael Leibowitz right here on the show, Real Investment Show. Of course, I'm your host, Lance Roberts. See you tomorrow.
It's a rich man's world.